Thanks everyone for joining this webinar today. Of course, we're going to be talking about a combination of the U.S. macroeconomy and how that flows into the U.S. oil market. My name is Ray Jansen. I am a macroeconomist here at Kpler, joined by my colleague Matt Smith, who is head of crude analysis here at Kpler. We are part of the research team. We are putting out research notes on a weekly basis. For those of you who have maybe not seen our research product, we can get you set up with a trial. Reach out to sales@kpler.com. Of course, as we go through this presentation today, feel free to ask questions. We'll have a 10-minute Q&A session here in about 30 minutes. I'll speak for 15 minutes. Matt Smith will speak for 15 minutes, and then we'll do some Q&A. With that being said, let's go ahead and move forward. I'll open the discussion on the macro side of things for the United States. Our core narrative for the U.S. right now is one of run it hot. It is the Trump administration is, and just generally the pace of the U.S. economy right now is one where inflation remains above the Fed's 2% target. It's our view that the U.S. economy is in a world closer to 3% inflation versus 2% inflation, and yet U.S. growth does continue to perform roughly in line with the long-run trend. This is a notable change from earlier this year, say after mid-April, following the initial implementation and then rollback of Liberation Day tariffs. We saw growth at under 1% this year. But as we've kind of rolled through over the last couple of quarters, and Trump rolled some of those tariffs back to a degree, we've seen the U.S. economy manage to push through, not only on the investment side, particularly across business equipment investment, but also across the consumer. Interestingly enough, though, as I mentioned, inflation does remain a problem. So we're kind of sitting in this reality right now in the U.S. economy where growth is doing okay, kind of sitting in line with historical trend, but inflation remains a key problem. And of course, the real downside for the U.S. economy, especially into next year, is if we do get a pickup in layoff activity. We haven't seen that happen yet. But of course, it looks like the Fed is quite focused on this side of their employment mandate. And I'll talk a little bit more about what we saw out of the Fed meeting here in a little bit from yesterday. But first, just breaking down kind of the key components of the U.S. economy. Roughly 70% of U.S. GDP is a result of household consumption, so it is the core driver. If you look at that left-hand side chart, there was a clear flatlining in consumption activity early this year. There was a lot of uncertainty around tariff implementation and things like that. And we saw growth levels through the first 4 or 5 months of the year really fluctuate a lot as consumers brought ahead some purchases to try and get ahead of tariff implementation, things like that. But broadly speaking, things were flatlining. But the situation has picked up over the last few months. We have seen improvements in household consumption growth. Again, if you look at the right-hand side chart, even just removing inflation, the consumption picture looks much better for the U.S. Even if you look at official GDP figures, Q2, we initially saw a 1.5, 1.6% household consumption growth figure. That's 100 basis points below the historical trend. That was revised higher to 2.5%, in line with the historical trend. And into Q3, we're likely around those levels again, 2.5, 2.6% growth for the consumer. This is helping to pull U.S. growth higher. Of course, the real open question is the labor market. We have seen, if you look at the right-hand side chart here, we have seen a stark deceleration in U.S. job growth this year. We're now running at a pace of roughly 25,000 jobs created per month on a 3-month moving average basis. Keep in mind that this is ADP data. This is not official U.S. data given the government shutdown. Part of the reason that we have really not seen the unemployment rate move up very much, though, is because the extent of the U.S. labor force is flat to negative on the year. And so that has provided a stabilizing force despite the lack of labor force growth. I think the real risk into next year is that we see, in that right-hand right-hand side chart, we start to see job growth push into negative territory, and we actually see layoff activity start to happen. If that occurs, I think the outlook for the U.S. economy weakens quite a bit. That is not our base case right now. We actually think that the steady state pace of job creation in the U.S. is likely in a range between 0 to 50,000 jobs, not a lot, and much lower relative to where it was during the Biden years when immigration was much higher. I also like to highlight the reason why I think we have seen a more persistent uh, pace of consumption growth than many had been expecting, say, coming into the summer, including myself. And I think it's the equity market has just been relentlessly bullish. The top 50% of US households drive 70% of US consumption and own almost all US equities, right? So if the equity market's trading higher, those folks who tend to drive the majority of consumption in the US feel richer, and they go out and spend some of that money. And so we do think that, I think if US asset prices continue to push higher from here, you will continue to see this consumption impulse. This does indicate, though, and does kind of key into this idea that the US is very much living in this K-shaped economy. If you're in the top 50% of households, if you own a lot of US assets, you're doing pretty well. If you're in the bottom 50%, you don't own any US assets, you're dealing with a structurally higher inflation rate relative to the last couple of decades, you're not feeling as good. And so I think there is a key delineation there. But when we're thinking about consumption, it's that those top income cohorts that really do drive consumption growth in the US. Switching to the investment side, investment is roughly 20 to 22% of US GDP, depending on the quarter you're looking at. The business investment part of the overall investment piece in the US, which is buying equipment and machinery and things of that nature, were very strong through Q1 as firms attempted to front run tariffs. That growth persistence really carried into Q2 and even into Q3. We are at least on the industrial production side of things. It is looking like things might be starting to flatline. When we get updated data here, when the government eventually reopens, we'll need to keep an eye on whether that flatlining continues. On the durable goods side, though, more persistence over the last couple of months. So again, I would argue that across this business investment piece of U.S. investment, which is roughly 1/3 of that investment piece, has been pretty strong through the first 3 quarters of the year. I think we'll probably see more weakness across this particular part of the economy heading into Q4, just as that tariff front running kind of starts to fade. And of course, if you look at the property market, that's the other big piece of U.S. investment. It's weak. Construction activity has been in full-on recession since last summer. Permit activity is at post-COVID lows. Not a lot of signs that this is starting to rebound in any kind of way. And I think that this is the weakness in the construction market will likely continue until we see mortgage rates, if we're thinking about the housing market, are going to need to come down quite a bit from current levels. I'd say, we really need to see mortgage rates under, 5%, 4.5% to be more stimulative. Just thinking about US monetary policy now, the Fed meeting yesterday, oftentimes Fed meetings are, maybe a little bit, not a lot of information comes out of the Fed meeting and out of the press conference. Yesterday was actually quite interesting to watch. Powell was notably more hawkish than the market was expecting. If you look at the chart on the right here, the expectations for a 25 basis point rate cut in December were nearly 100%. Before the meeting yesterday, that has now fallen to roughly 60%. We saw yields rise while Powell was speaking. We saw gold sell off, equities came under pressure. And again, a lot of this was driven by the fact that Powell himself came out and said, look, a December rate cut is not a foregone conclusion. And then he reiterated that statement a couple of more times. So again, the market has been very aggressively counting on rate cuts, and we still think that there will be a rate cut in December, but Powell definitely took a bit more of a hawkish stance than we were expecting. And again, that market reaction has been really interesting. Just even in the bond market, big move in the 10-year yield, big move in the two-year yield higher from levels before the meeting. We also saw, again, risk assets come under pressure, and the US dollar strengthen as well. We got a big breakout in USD JPY this morning, right? So a lot of moves that you would expect with a more hawkish Fed have really followed through into today. So we'll have to keep an eye. Again, we still expect the Fed to continue cutting here, but the hawkishness was notable to watch. Of course, on the inflation side, as I mentioned, even though U.S. growth is, as U.S. growth is doing better than expected, inflation remains a problem. Core inflation in the United States sitting at 3% roughly. And again, this is kind of our feeling is that, again, as I mentioned at the outset, inflation in the US is, I think, in a world that's closer to 3% rather than closer to 2%. And this is, you know, the Fed, despite the dissension on the board, the FOMC, I think that the Fed has made a decision to stimulate in an attempt to prevent further weakening in the labor market, especially around the potential for more layoffs next year, and has kind of, maybe put their inflation mandate on the back burner a little bit. However, I say that with the understanding of Powell's a bit more hawkishness yesterday. So kind of interesting. I think there are people on the FOMC who do and who are still quite concerned about the inflation side of their mandate. So we'll have to keep an eye on it. Lastly, just looking at US tariffs, um, I really want to focus in on this trade balance for the United States. It has been our view at Kpler that US tariffs would provide more income to the US government, but would not do a lot to rebalance the global trading system. And we are starting to kind of see that reality play out. Obviously, in Q1, the trade balance went really negative as firms attempted to tariff front run. It narrowed into Q2, but then we're seeing the trade deficit get more negative again into Q3, right? And this is kind of critical to understand that the U.S. is starting to import a lot more stuff again as we head into the end of the year. And of course, as you can see in the right-hand side chart, tariffs are providing more revenue to the U.S. government, but this is not necessarily on its own going to rebalance the trading system. And of course, just one note on the Chinese trade deal, it's a relatively minimal deal. It really doesn't change the status quo. And I think that ultimately, America's trade deficit is going to look more negative than Q2 heading into the end of this year. So with that being said, I'm going to let Matt take over and kind of talk about how all of this macro talk flows through to the oil side of the ledger.
Thanks, Reed. Okay, as Reed said at the top of the show here, we're just going to talk for 10, 15 minutes each. I'm going to keep this kind of pretty simple as I like to do. We're just going to take a quick view across supply, look at runs, inventories, product demand, crude imports, crude exports. So if we jump straight to the first slide here, in terms of the production side of the picture, now, people smarter than myself have come up with our forecast here. So this is Johannes Raubel on our crude team on the left-hand side. Our expectation for next year in terms of US production is that we only see a minimal drop. So we're looking at about 100,000 barrels a day lower. So from 13.5 average this year to 13.4 for next year. We've got a couple of scenarios there you can see for the April forecast. We were looking at things being stronger than we do now. I think the key thing to look at here are the scenarios that we have in that left-hand chart. So looking at around a $50 level, that's when you really see production activity really start to drop in the second half of next year, and we see it dropping below 13 if we got to that level. That isn't our base case though, right? So that's why when you look at our forecast here, it equates to essentially a price on WTI basis in the high 50s there. Now, We are not doing this on a wellhead by wellhead basis. We are looking at publicly available information. We're looking at company reports, company projections, all that type of stuff. But you can see the slowing right in the market here with the two charts on the right hand side there. So top right, just looking at the ducks, you can see the ducks are being tapped there. Key thing to bear in mind or to observe from that chart is that the drop is coming through from the Permian. Now, when we look ahead to next year, we're looking at say North Dakota dropping by about 50,000 barrels per day. We see New Mexico adding a little bit, but really it's essentially a wash there that we're seeing on the shale side of things. And so that's why we're saying US shale is essentially peaking out right now. Bottom right, we're still going to be playing catch up in terms of the rig count here, but reality is we've dropped from 480 in early April down to 420 here, so that's going to have an impact, even though we have been seeing efficiency gains kicking in. So that's on the production side of things. So if we move to the next slide and look at the run side of the picture. So runs have been strong, particularly so looking on the left hand side there on the over the summer period, which makes sense, right? When we've seen refining margins so strong, particularly led on the diesel side of the picture there, that strength has really driven on these runs. But really versus last year, we were up a little bit. Maybe it's like 160,000 barrels per day. We are backfilling all of our S&Ds with the EIA official data here. So that's what you're seeing for last year and what you have seen for first 7 months of this year. The rest is our projection. But for next year, we are looking at some retirements coming through, but that is going to be offset by refining margins continuing to incentivize refiners to run as pretty much as hard as they can. So in terms of runs, if we've averaged, or we're looking to average 16.36 million barrels per day this year, next year we're looking at to drop by just 100,000 barrels a day, 90,000 barrels a day. So pretty much around a similar level there. So we have production coming off a little bit. We have the runs holding up. On the right hand side here, you have inventories for the US. Now, we have had the situation where the import side of the picture has been challenged in the US, and so that's why we've seen them somewhat flatlining, and it is a bit of a concern, to be honest, right? We're talking about this imminent glut that we're going to see in the markets coming through, and we obviously see it in oil on the water. We're seeing record global crude exports, but we're not yet seeing it showing up in inventories. It may not be the US where we see that show up to the largest extent, right? When you consider Saudi Arabia prices its crude so that the US doesn't bring it in. So we see these barrels being kept away from the US. But point being is we've seen these inventories remaining low just in the last few months here as those imports have been in check, runs have been strong, and on the export side of things, they've been pretty strong as well. So if we just take a look at the demand side of the picture on the next slide here. There it is. So just looking at diesel and gasoline, not a huge amount going on here in the grand scheme of things. So if we're looking at the diesel side of the picture, looking at it pretty much being very similar to last year, this year, and next year, right? So we're not seeing too much of a change after everything had been shaken up, essentially with the renewable diesel side of the picture. Even on the gasoline side of the picture there, we've seen a drop of only about 20,000 barrels per day in terms of demand for this year versus last. Next year, we see it dropping about 50,000 barrels a day, but that's about it, really. In terms of where we are on the inventory side of things, on the export side for the US, exports out of the US for diesel have been particularly strong, although we have seen them reined back in sort of August, September, October time. Kind of makes sense as those barrels have been held on and we've seen inventories build a little bit. But the reality is for gasoline, diesel, and for crude to a large extent, we are at the bottom of the 5-year ranges here. And that's more of a new reality that we're in for these inventories, as opposed to any of them getting back to their 5-year averages. On the gasoline side of things, similar picture to diesel. Well, kind of in that we have seen it holding around year ago levels, but we haven't seen those exports dropping off really in the last couple of months versus those year ago levels here. But really low inventory environment is likely to persist here. We're very constructive, particularly on the diesel part of the barrel. moving on to the next slide here. So now, we've done the product side of things. We'll just take a look at the flows, right, which is our kind of bread and butter. So the chart over on the left here is just showing the crude import side of the picture. So as I mentioned, we have been seeing these in check. One thing to bear in mind is that you have about 4 million barrels a day of crude imports coming in from Canada. What has happened though is we are seeing them lower. You see it coming through in the monthly EIA data, right? Sort of particularly over the second quarter of this year. So as TMX has started up and is pulling those barrels to basically the west coast close to Vancouver, Westridge there, and being exported, you're not actually seeing all of that come into the US West Coast. Actually, you look at the data for October, the vast majority of those TMX barrels are being exported to China. It's a small piece to the US. And even on like a normal month, we're not seeing more than 150,000 barrels a day from Canada there going to the US West Coast. So you're actually seeing lower Canadian imports into the US on the aggregate because of that, at least for now. As Canadian production increases, we'll likely see that turnaround. But for now, point being is that those flows have been lower. On a waterborne basis, you can see on the left-hand side here, this is taking it back, over the last kind of 8 years, just to take a look at the evolution. Point is that we're seeing them pretty low. Imports into the Gulf Coast are out 1.1 million barrels per day, into pad one about 500-600, and about 1 million into the West Coast. We'll take a look at East and West Coast in a minute, but just looking on the chart on the right hand side, this for me is like such a huge part of the market this year. And essentially what this is showing you is how, if you focused on the dark blue bar on the right hand chart there, how you're seeing it kind of dropping that on an annual basis. That says those Mexican flows into the US Gulf Coast have continued to drop because of lower production, and to a lesser extent higher refinery runs out of Mexico. They're keeping those barrels at home. Now, we have seen the red bar increasing there as Chevron's license with Venezuela has kicked back in, dropped back out, came back in again, right? But we're seeing those flows supplementing those heavy sour barrels, but by no means are they offsetting them. But the point with this chart is to show you, if you just look at 25 versus 24 there, you just haven't found a substitute for all that heavy sour crude. Yes, you've seen more being pulled in from Brazil. The Guyanese stuff was more of a kind of a panic buy that we saw, late Q2, just with the license from Chevron being revoked. But those are both not good barrels, apart from like a really heavy Brazilian barrel like a Peregrino to replace a heavy sour Mexican or Venezuelan barrel. So what has happened on the US Gulf Coast? Those imports have simply dropped. Right, you can see that on that bar on the right hand side there. They just haven't been replaced even with medium sour barrels. Those imports have just been low, and so that's why we have been seeing these inventories very much in check here. One thing just to bear in mind before we move on to the next slide. So just with the latest EIA report that came out yesterday, I think it surprised quite a lot of people. Even though we saw a build at Cushing, we are seeing another build so far in Cushing, about 1 million barrels so far this week. So as Midwest refinery runs have come off, you're seeing Cushing starting to rebuild from critical levels, basically. Point being, though, that was an aside. When you look at these Gulf Coast imports, they actually hit the lowest level on our records last week. So we only saw 530,000 barrels a day being imported. 150,000 barrels a day from Mexico. There was actually only 5 countries that sent crude into the US Gulf Coast last week, which is very unusual. So that, combined with strong exports, is the reason that we saw a really solid draw to crude inventories yesterday. It all comes back to the flows. That's the point I'm making here. So we should see those imports rebound. If we go on to the next slide and just take a look at the West Coast and the East Coast. So they have very different kind of refinery diets, different tactics, strategies, dynamics in terms of what they're importing. So if we look on the left-hand chart in terms of Pad 5 here, you have seen a change as TMX has started up. You're seeing more Canadian crude coming into the West Coast. We have seen a drop-off come through from Iraq, from Saudi as well there. Interestingly, is the light green is Argentina there. So Argentinian crude, as we've seen at it's Puerto Rosales, basically, port there, which is now able to load Suezmaxes. You've seen total Argentinian crude exports popping. That is predominantly light sweet Medanito, and that is going into the US West Coast. So you look at that, it looks about 100,000 barrels a day. So that is 100 of the 160 that we're seeing them exporting so far this year. So that's interesting. Also with the Guyanese crude going in there. But as to my point, you are seeing a lot of the Canadian stuff going in. So you're taking these lighter crudes and blending them with those heavier barrels there. On the East Coast, it's a very much a different situation, at least for a number of the refineries there. So it's more polar this time. It's more polarized in terms of destinations. So Bayway takes a lot of crude. Monroe, so that's the Delta Airlines refinery, that takes a lot of Nigerian crude, as does Bayway. And so about a quarter of the imports that are coming into the US East Coast are Nigerian crude. So you've seen a lot more light sweet crude that's coming in. You'll see versus the West Coast as well, there's that others area there. So you do have a lot more kind of random barrels that come in from, say, Algeria, CPC from Kazakhstan. You've got North Sea crude, and I've got Libya on there as well. Yeah, so it's a kind of different countries are supplying that crude. They are kind of lighter barrels, though. We do see heavier barrels come in, though, to get blended there. But what you're seeing is less Mexican crude has been coming in over the last few years. And so we've seen Colombia stepping up to fill that gap there. You also have shuttling Saudi crude that comes up. They'll send a VLCC, they'll send some into Port Arthur in the Gulf, and then you'll see it shuttle up to the East Coast as well. So point being is these imports are fairly steady. As we get refinery closures going forward in the years ahead here, nothing for the East Coast yet, but we should expect on the West Coast with Valero Benicia coming up at the end of Q1 next year, these imports will start to drop. Okay, on to the next slide. Thank you, Reed. Okay, sixth and final slide here, just looking at the export side of the picture. So if we focus on the chart on the right-hand side here, we are seeing on an annual basis US crude exports potentially peaking out unless we see that Brent TI spread really blow out. So just looking in terms of where those flows are going, we have seen, well, traditionally, right, like early this decade, late last decade, the majority of the US crude was going to Asia. When you saw the Ukraine-Russia conflict start up, you saw a lot of US crude then going to Europe to backfill Russian material. And that's when you've seen that European piece increasing. Now we're starting to see that come off. You can see it in the 2025 bar, that largest dark blue area there, as you're getting, say, CPC and others increasing into Europe in terms of competition, but also refineries shutting down there. You've also seen it drop off to Asia. Asia has been picking up in recent months, so it has been stronger there. But then even with the piece that's going to Africa, so we have seen Dangote taking as much as over 300,000 barrels a day of US crude in the summer here. That's very incremental piece of the growth. And so again, this is taking out the Canadian crude exports that leave out of the Gulf here. Once you add those in, it gets us closer to that 4 million barrel a day mark. But point being is you're seeing them somewhat in check. And on the left-hand side here, you can see it's only if looking at the red line, it's only in recent months here that we have seen US crude exports really picking up. They've been much lower than the last few years through the first 7 months of the year. We have seen that Brent TI spread really tight. We've seen Cushing inventories tight, really just keeping those barrels at home. It's only really in the last couple of months where we've seen those exports increasing. Just one last thing. I did mention the Canadian crude exports out of the US Gulf, re-exports, if you will. Those have actually been rebounding in the last few months here. So last month, we saw them get up to about 130,000 barrels a day. That's the strongest they've been since early 2024. So it is our expectation that Canadian crude will ramp up again out of the Gulf Coast as we see Canadian production increasing. We just weren't necessarily expecting it to happen just yet. We'd expect it kind of happening next year, but we're already seeing signs of that. So Canadian crude out of the Gulf is about 130,000 barrels a day so far this year, just down slightly versus last year, which is pretty impressive, I think. So with that, that's my 15-minute rant. I'll pass it over to Reed and we'll see if we have any questions.
Awesome. Thanks for that, Matt. And of course, yeah, please ask your questions here. We're going to go for 5 or 10 minutes. Matt, we'll start with you. Just a lot of stuff, maybe not totally US focused, but just obviously we have the US inventory situation. We saw the draw reported by the EIA recently. How does that flow through to the broader global S&D situation? Do we think that we will start to see builds here, uh, into next year? What's your view?
Yeah, sure. So, so we are seeing crude exports really strong, right? It's been a kind of a culmination of things on the export side where it's seasonality, meaning that OPEC exports are really starting to rip. You see it with Saudi. Saudi's exports in September versus August are up 800,000 barrels a day. They're just finishing higher in October here than September too. So you've got them, you've got UAE, etc., that are increasing exports at the same time as you have non-OPEC increasing too. So from Brazil and new Guyanese crude stream, US crude exports have been strong as well. And so you have got a lot of crude exports, and you've seen that on the water. Yes, there's a lot of long haul activity that is somewhat inflating that oil on the water, but you cannot deny the fact that when you have exports September up over 3.5 million barrels a day higher than the previous month, you're going to see a jump in oil on the water. So now it's a case of waiting to see those inventory, those barrels either show up in inventories or be run through refineries. But it's a seasonally weak time in terms of refinery runs. I know we're coming out of October now, and November's going to be stronger, but and we are seeing, even just with the Saudi side of things, a lot of that crude, 10 million barrels has increased in Egypt, right? And so that's gone into their strategic storage there. A lot of it's probably going into Europe. We're not seeing China, we're not seeing it head into China like we did over the kind of April to September period, the April to end of August. And so all that is to say is that we're moving through to this point where we expect to start to see this showing up in inventories. And so, yes, it appears there is the glut, right? And it is coming and it will start to be visible. The US piece of it is the challenging one in that, and I kind of mentioned this in that, like, because it's the largest, most transparent, most timely market in the world, the likes of the Middle East try and keep barrels away from the US because it just makes it more well supplied, and that will weigh on market sentiment and weigh on prices. And so we may not see it really showing up in the US side of things, or that may be one of the last places to do so.
Fair. And just a question here. Do you think Cushing could get back to 30 million barrels in the next half year?
I just wrote about that in our weekly report. We should be publishing it if it's not published already. So it's yeah, really interesting to see a decent jump last week. As I mentioned, we're up another million barrels so far this month. So far this week, sorry, that's our midweek reading there. But if you look at Cushing inventories over the last year, they have moved within a 20 to 25 million barrel range there, just this tight range. And I think we're going to hold within that just because it's a new dynamic at Cushing in that those barrels, the Canadian barrels are just simply not staged there. The increase that we're seeing at Cushing is Enbridge barrels, right? So it's Canadian stuff that's coming down because refinery runs in the Midwest last week in this week's EIA report were the lowest since I think it was like December 2022. Either way, it's a multi-year low, 3.4 million barrels a day of runs there. And so it seems it's more of a temporary phenomenon more than anything else. Last year, we didn't see the typical build in Q4 at Cushing because of TMX, and I think that will be the case again. So that's the long-winded way of saying no, I don't think we get to 30 million.
Fair, fair. Maybe just to shift over to the macro side here, it's looking like we have a question around just the government shutdown and consumption levels. Obviously, I mentioned earlier in this presentation that U.S. consumption activity was doing pretty good. And I think the reality is that the shutdown has a relatively limited impact on outright consumption levels. There's two reasons for that. One, again, your top income cohorts typically don't work for the government, and they are the ones who are driving spending growth. But also, uh, federal workers are guaranteed back pay. So some of these federal workers can, to an extent, kind of income smooth a little bit because they know that they will receive a guaranteed paycheck when they come back to work. The only caveat to that is that contract workers will not. But I think that for the most part, it's a very marginal impact. Of course, if we're a month out, a month later from now, and the government's still shut down, the effects do start to compound somewhat. So we'll need to keep an eye on it for sure.
Are those contract workers, Reed, are they weighing into the deterioration we're seeing in the employment data, or is that's just happening anyway?
The problem is we don't know
Yeah.
because we have no employment data. Um, so yes, my expectation is yes, government employment growth has probably slowed. You also had there was a program if you wanted to get paid and leave the government under Doge early this year. That deadline was October. So yeah, it's probably going to flow through the data, but we really don't know to what extent yet.
Wow.
Yeah, yeah. And just looking through here, um, just another question around kind of expectations for rate cuts next year. Look, I would say going into the meeting yesterday, the expectation was somewhere, you know, the expectation was somewhere between 100 to 125 basis points of cuts by the end of 2026. I still think that we are probably going to get to somewhere around that range, which would now imply somewhere between 75 to 100 basis points of cuts by the end of next year. Just because, again, while we may see a bit more caution first half of next year, Powell will be exiting the chairmanship in May. Trump's going to have his guy in place. And so you could see a more aggressive set of cuts even into the summer. And again, this kind of flows back to our expectation that the Trump administration is going to pull a lot of policy levers to keep this US kind of growth story going, even if inflation remains, quite a bit above target. They're going to try and push a lot of liquidity into the market here.
And Reed, part of that, I know you said that you think there's still going to be a cut coming through in December. Do you think the reaction was overdone yesterday when it was basically you saw that probability of a cut in December dropping?
I don't think so, just because the market was so optimistic.
Hmm.
And look, we're in an environment where equities just continued to push higher. Obviously we saw a sell-off in gold, but the debasement trade was just fully on through September and parts of October. And so kind of taking a little bit of a breather, at least in the bond market, right? We saw yields move higher. Kind of makes sense, just given how optimistic folks were about Fed cuts. On that point, too, for folks who are maybe in the oil market here, we have seen a big weakening in the US dollar this year that has probably played a role in supporting domestic consumption in places in some emerging markets. We do expect through the end of the years some reversal in this trend where we could see a bit stronger USD into the end of this year, just given the fact that US growth is performing better than expected. But I think by the middle of next year, we're probably moving back into a structural bear market for USD. But for those who are maybe thinking about the shorter term outlook for US dollar, um, maybe we'll do one. Matt, we'll come to you for one more question and then we'll call it here.
Okay.
Um, this is kind of back to the kind of global inventory story.
Hmm.
Just question around, we've seen all of this oil on water, with the high export levels. Do you have any idea where a lot of this volume might end up, if not the United States or China? Do you have some other expectation?
Yeah, so you can see a lot of it is still heading to Asia. And so the expectation is that you're going to see it go into to other countries in Asia, whether it's Japan, South Korea, etc. There's also with Europe as well heading into there. And so I think that's the key thing. And so yeah, that's the short answer is that a lot of it's heading to Asia, so it should end up there, OECD there, but also Europe as well. The interesting thing I think when we kind of consider just the broader picture here, like we were with Amina last week, reading myself in New York, and she was saying that OPEC are very much focused on those OECD inventories, and so I think it's going to depend where these barrels land and build to how much impact they have on prices. So if we do see them heading into OECD inventories, that will likely weigh on prices more, but it will also give OPEC more pause for thought than if these barrels were just going into non-OECD and somewhere like China.
Awesome. Thanks for that, Matt. With that being said, we'll call this webinar. Again, for folks who are not aware, we have a research service at Kpler called Insights. If you don't have access, we can get you trial access. Reach out to sales@kpler.com. We put on these webinars regularly and also have research for clients on a daily basis. Anyway, with that being said, thanks. Have a good day, and we'll see you again soon. Bye bye.